Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Trane Technologies. And Trane Technologies is a little bit more of an unknown stock for many people because they are in the HVAC business. And what a lot of people don't always connect the dots on is with this AI data center build out, there's a lot of cooling needed. And they are providing HVAC for a lot of that cooling for the AI data centers. So they're a little bit involved of this big AI boom. So this is going to be an interesting analysis. But before we get into the analysis, make sure to subscribe to my channel. Balance sheets matter because I do individual stock analysis videos. So if you like looking at individual stocks, potential stocks to buy, and value traps to avoid, make sure to subscribe to the channel because what I do is I dive into the financials, analyze them, look at what's improving in the company, what's deteriorating, and from all that and getting the overall picture, that I try to determine what a good valuation for the company could be if we want to buy it and where that spot we would want to buy it is. And with that, now let's get into the analysis. So you can see here from the top level metrics, according to the Group Focus Value Band, which is sometimes accurate for predictable companies, it's thinking that Trane Technologies is a little bit on the overvalued side. And if we do look at the PE ratio, we do see they have a fairly high PE of 37.41, but their forward PE is 32.75, which does say the analysts are expecting some EPS growth going forward in the future. And they do have a little bit of a dividend yield of 0.81% with a payout ratio of 0.29. So dividend investors, this isn't the biggest dividend out there if you're looking for one of those types of stocks. So let's dive into the financials now. So while they have grown a lot recently because of this AI boom, and I will say they also do have a partnership with NVIDIA and have been developing custom cooling systems for those different chips. The revenue over the last 10 years has actually grown only averaged at 6.6%. Although if we look at the analyst estimates here and look at the green line, which is the projected revenue growth by basically the analyst consensus right now, they're expecting them more to grow at that basically 8 to 10%. And you can see it is above the mean average trend line in the past. And even though their revenue growth has been below basically 10% and is expected to be at 10 or below going into the future, the EPS growth has been at over 12%. As we can see, the last 10 years, it's been 12.4%. So as we dive into the financials, I'm going to explain what a little bit is behind that. One of the first things we can just kind of get a look at is we turn to look at the return on invested capital compared to the weighted average cost of capital. And you can see the return on invested capital has been getting higher and higher, meaning when they are investing more in their company, they're actually getting higher and higher returns. And this does largely coincide with this recent AI boom that's been happening and which is driving actually quite a bit of their business. So with that, we can start looking at the income statement. And you can see, let's just actually pop up a little bit of a longer time frame here, 20 years, just so I can give a little bit of a better perspective. You can kind of basically see since 2020, this is when things really started recently taking off, going from, about a little bit over 12 billion, 14, 16, 17 and a half, almost 20, and now, 21 billion. Where in the past there, they were kind of stuck at this, $12 billion mark basically since 2011 with a little bit of fluctuation, and it was a little bit lower in the past. So the one big thing to connect is, well, their business is in HVAC, and with people are going on about global warming, and there's more government pushes towards HVAC systems as well. What really is driving the growth right now is the AI boom, because that stuff has existed in the past years before 2020, and that really was not providing a driver for the revenue growth. But the one really nice thing about them that we can see is their gross margins. And you can see basically over the 20 years here, their gross margins have been going up. And this is really, really good because not only does this mean they're not losing a competitive moat, they actually kind of are gaining a competitive moat at the same time since they're able to charge higher and higher prices. And the recent years, as we can see from December 2022 to now the year ending December 2025, it's gone from 31% to 36%, may just be potentially temporary due to the huge quick surge in demand for the AI data centers. So this is something to keep in mind because this basically could potentially revert back down to more of this 30-31% range, which did exist pre-2022 back to about 2014. And why this is important is the valuation for a lot of companies, especially the PE ratio and the price to sales ratio, the market and analysts will give the company a higher premium if they are growing their gross margins or operating margins, which leak down basically to their bottom line net margins. So if this isn't going to potentially be happening in the future, this could mean some multiple compression, and vice versa. If they do manage to actually expand their gross margins more, this can mean they can maintain a higher valuation. And we can also see basically the same trend is happening with their operating margins as well. They've been growing, 10 years ago, it was around 10%, and now they've grown it to 18%. But the one thing you basically will notice if you kind of do the math of how much they've increased in comparison to the gross margin, the operating margin has increased in line with the gross margin increasing as well. So this is kind of saying that however they're scaling their business up from the revenue perspective, their operating costs are actually staying fairly consistent. And this is good overall, especially when you have these flat plateaus basically in revenue. But at the same time, it doesn't show they're able to get any operational efficiencies as they basically scale up. And all this effectively margin growth is just happening on the top line with the gross margin. The next thing is basically looking at their interest expense. And can we see right now the net interest income here, or which basically takes their interest income and interest expense, is just under $220 million. And this is a very manageable amount for them. As you can see, their operating income is almost $4 billion. So this is saying they are in a very good situation, basically, with their debt right now, where they can easily afford it. I typically like to look for about a 1 to 10 ratio, meaning they have 10 times more operating income than interest expense. Because once you start getting below that ratio, if you get a little bit of a rough patch, things can start to get a little tough for the company in their debt scenario there. And when they do have a very affordable interest expense, that does mean they do have the opportunity to take on more debt if they do need to potentially expand their business. But you can see this basically wasn't always the case, because a lot of this operating income has grown in the recent years. If we do look post 2021 here, you can see for a lot of these years, say from 2014 to 2020, their operating income was only around 1.5 billion, and they actually had a pretty similar net interest basically expense at the same time. So the one nice thing is with this growth here, this hasn't been fueled by debt at all. So this does leave a potential opportunity for them. If they did have opportunities for acquisitions, they would be able to afford to actually take out a lot of debt and do a big acquisition if such an opportunity presented them to that in the future. Not that I think they're actually looking at any of that right now in currently, but that is just a potential tailwind and upside potential that could happen. And then when we look down at the net margin, the same thing's basically been happening with the net margin. It's been growing in line with the gross margin increasing as well. So there's nothing basically new about that. And we can see they have been basically buying back some shares over time. It's not a huge amount, but they are basically, allocating some capital there to get that share count down. And well, they are paying basically a dividend and buying back some shares because they are a little bit of a high P ratio. It doesn't provide that actually much return to the investor at the end of the day. When we look at their balance sheet, there's not anything really too much remarkable here. The quick little analysis of it, I usually just look at the goodwill. You can basically see that they have about $6 billion. They've had around this level of the past, because they do, as you'll see from the cash flow statement, some spotty little acquisitions, and sometimes they have to basically write it off. And as they do more, they've maintained around that. And if we look at their total equity and we take out the goodwill, they would only have maybe about $2 billion of total equity. So it's nice to have a little bit of positive total equity, but it doesn't add a huge plus to the balance sheet, but it's also not a huge subtractor. For a lot of large companies, they usually do like to operate balance sheets pretty tightly, where you have a total equity that's usually around close to zero once you factor out the goodwill. And this is the case that Trane Technologies is currently in. So now on to the cash flow statement to see what they are doing with their money. One of the big things that's overlooked by a lot of investors is looking at the cash flow from depreciation and comparing this to the purchase of plant, property, and equipment. And you can see right now, what's actually interesting about them is they are really actually only at replacement value right now. And in the past, they've been actually at a little bit lower levels. So basically what this means is they're expensing so much on their income statement, their actual income could be considered a tad higher if you look at this. But the amount difference is very, very little. But this does basically at least tell us at the end of the day, the amount of income we're seeing is fairly accurate on their income statement. And you can see they do some very small purchases of businesses. If you did probably take all these and average these into the purchase of plant, property, and equipment, you could probably almost say it's at replacement value in that perspective. And you can see in December 2008, they did do a large acquisition. So if an opportunity does arise, as we discussed, they do basically have a low interest expense, and they could do a large acquisition in the future if that opportunity basically did present itself. And what are they doing with their money? Well, you can see they're basically buying back a lot of shares. But like most companies, what happens is it's very easy to buy back shares when you're making a lot of money in the good times. But then when the market crashes and you're not making quite as much money, you don't have that extra cash sitting on your balance sheet, and when your stock's the lowest price, well, you can't repurchase any shares. And that's what happened in 2008, 2009, and 2010. So you just have to keep in mind right now they're buying back shares, which could be at fairly expensive prices. And if the market were to sour, well, they're not going to basically have any cash aside to purchase the shares when the stock is actually cheap. And this is one of these things that actually can create big swings in the stock, but it actually can present opportunities for investors, because when those buybacks aren't there to support the stock, well, the stock potentially gets even lower, and you can basically buy it even cheaper. So if you are someone who doesn't just want to buy and hold a company forever, wants to buy it when it's cheap, maybe hold it several years, even like 5-10 years, and sell it when it's really expensive, well, this is what you need to really watch for to find those deep values. And then you can see basically the cash flow from dividends. Their dividend yield was very low. It's only $800 million. They mainly return share equity back to the shareholders in the form of repurchase of stock. And if we compare this to their free cash flow, well, their free cash flow basically in the last year was almost $2.8 billion. And even going back to 2016, it's been over $1.3 billion. So they're going to be very easily be able to afford their dividend, obviously, and at least in the short term, will be able to, on top of that, continue to buy back some shares, even if their free cash flow were to compress a little bit. Although, like I said, in recessions, even if they actually do have the free cash flow for this, sometimes they'll forego doing that just because of the risk and uncertainty. So with that, let's go into interactive chart, start getting some idea of what the valuation of the stock could be. The first thing to do here is pop up the revenue with estimate. And we already briefly looked at it before, but you can see in year ending in 2026, they're expected to have, by analysts, the analyst consensus at least, is 23 million, then 25 billion, then 27 billion, not million, billion, that's what I meant to say, 31.5 billion, and then 33.7. So this is in line with that, around 8 to 10% revenue growth rate. But if we do compare that to the EPS, basically with estimate here, the EPS is expected to grow at a lot faster rate. And the EPS, you can see ending in 2026, a little bit under $15 at $14.80, $16.84, which, this is definitely over a 10% jump. And then $19, another fairly big jump, $24.47, and $26.64. So this is when I start having basically a little bit of issue with the analyst estimates here, because the only possible way for this to happen is if their margins continually keep expanding and they're able to buy back shares. And with a relatively higher PE, we're seeing they're actually not able to reduce their share count at a very fast rate. So this would mean that they would have to actually have a lot of basically continual margin expansion, which may not be likely going in the future, basically, in my opinion. As I said, at some point, we don't know when. We're getting a little bit of a boom right now from the sudden influx of AI data centers needing the cooling. But at some point, that probably will moderate. And I'm not even saying crash, but just moderate. And that may put some pressure on their gross margins to either stall or potentially go back down to where they previously were. But this type of trend here, and this is the problem sometimes with analysts, is they project what's happened in the last few years, basically going on indefinitely into the future. And while it is very possible that Trane Technologies is able to basically expand their gross margins a little bit more, I don't think they're going to be able to do it at this rate that the analysts are currently pricing in for the stock. And now let's look at some other valuation metrics. We will bring up the price to earnings ratio. And with that, you can see historically, I'll bring up a little bit shorter time frame. You can see historically, basically before 2020 and this recent kind of boom from the revenue growth and the AI, they typically did not trade at a high PE ratio. They were trading, as low as a 7, and maybe on the high side, we're getting into the low 20s. But this was also a period when they basically weren't getting any growth either. But they did have good margins. It wasn't, decreasing or anything. But that was this is a historical kind of frame of reference if the revenue basically were to stall. And then you can see, once basically after 2020 and the revenue started increasing and we've got this like more AI boom going, now their low side for the PE has been about 20. And that was previously before was a very high PE for them. And their high side has moved up to 40. And one of the reasons that I believe it is so high, relatively high right now, is because of the net margin and net like gross margin, operating margin, and net margin expansion. And I'm going to basically show that here. Let's bring up the operating margin. And if we take away the price to earnings ratio, just remember it was like right at basically where we got the little gray line here that before they traded maybe a 7 to 20, and now they're trading a 20 to 40. So we take that away, and you can see this, high premium PE basically was, given to them at the point when they started expanding their net margins. And this is one big thing that the market and, the market, when I say, the institutional investors, the market, the analysts do, when they see the net margins expanding, they will give companies premiums for that. And potentially that net margin expansion can happen for a long time. And that's when you do get these really big aggressive runs in the stock, and there's a lot of gains basically stacked on. But you do have to realize when these do stall out, the company will get repriced back down to probably more of historically accurate PE. And while it may not get down to those sevens, if the revenue actually was flat, it could. But even at a more slower, moderate growth rate, we may only see it trading in a, say, 15 to 25 in the future, which would be a big re-rating down compared to the 37 P right now. So while Trane Technologies is doing really well, they do have a lot of these tailwinds behind them. The problem is, if those tailwinds fizzle out just a little bit, there's a lot of potential downside for the stock. Another thing we can basically look at on my relative valuation here is we look at the dividend yield. Because typically when the stocks are low, that's when you have a higher dividend yield, because a lot of companies, they keep very consistent payout ratios. And I think something like Trane Technology, judging by this chart, they basically have in the past. As we knew back here, the stock was kind of flat and quite cheaper for a while. The dividend ratio was on the higher side. And if you did buy basically when the dividend yield was high, there was a lot of potential upside for the stock there. And when the dividend yield was basically low in the past, that's when the stock was really high and there was a lot of potential downside. And well, where are we right now? Well, the dividend yield is sitting really, really, really low. Very, close to historically, low levels compared to actually 2011 here, which probably was, they already cut the dividend because they had a lower revenue. But even from this point here, the stock actually still did drop quite a bit. And, it's like basically lower than, we were seeing at the bottom of 2022 and even at these other times in 1999 and 2004. So these are all leaning on the side, as you can see, that I do think Trane Technologies is definitely on the more expensive side. Well, it is a very high quality company, and even with the AI data centers, the HVAC systems do need to be replaced. They do need to be repaired, and they probably are going to get that basically business potentially going in the future. If they get any basically deceleration in their margins, I would expect a very large multiple compression in the stock. And now we'll just bring up the price to sales, which is basically going to kind of reaffirm what I've been saying here. And you can see before, the company traded at a high of maybe just over a 1 price to sales, an average of, 0.75. And, sometimes in the 2008, 2009, they got quite low down to 0.2. And now they're trading at like a 5, which is near an all-time record high. And, if you kind of just, take the ratios of that is, from a 0.8 to a 5, is there really a justification for that type of expansion if we look at their net margins? So let's get up the net margin again here. Because like if your net margin were to double, it can make sense. Oh yeah, your price to sales ratio should double too. But right now, basically, the net margin is basically sitting around 13%, maybe 12% on average. And if we go back even, into 2016, they still actually did have some good years where it was around 10, 11%. There was some lows of maybe 7 or 5, but really the most we're looking at is 2, maybe 2.5 times for the lows, maybe really on average, maybe kind of like double what they are currently doing right now. So I don't think this large 5 times plus increase in the price to sales ratio is basically really justified. Now, if we look at kind of the trend here, the overall long-term chart, this trend is at an average compound annual growth rate of about 10% per year, and kind of does encompass the long-term trend of the company. As you can see here, And we've had touch points there. Obviously during 2008, it cut a little bit through, but we kind of resumed this trend relatively parallel with the moving averages. And you can see historically, when it wasn't growing at a rapid rate, it did stay in this little bit lower channel trend here. I'll just kind of draw out and basically in there. And now, because of the recent boom, it has actually really expanded up the top. And like I was saying, if there were to be some margin expansion, where's our multiple compression, we are sitting at a 37 PE right now. And if that basically were to drop, which still means they can actually be growing going forward, if the company was still, say, getting 6-7% revenue growth, but their margin stalled, that probably would justify quite a bit lower PE. And potentially what I would be seeing from a technical perspective, and which will probably align with the fundamentals as well, is we would probably want to start waiting to see the stock drop down to about the 200 mark or even potentially lower, which is around this 2022 consolidation level. So this isn't even predicting doom and gloom for the company. This is really just for saying that, hey, if we just slow down a little bit in the multiple expansion, we have a lot of downside. But in the short term, well, the stock does look really bullish. It could keep going up, but that's basically not the game I play. I wait till there's a deep value. So basically, Trane Technologies, this is a stock that I do have on my list. I do say I have a lot of stocks on my list because I legitimately do have hundreds of stocks on my list. But the thing is, it can sometimes take years and years, if at all it ever presents, the opportunity to buy them at a deep value. You don't have to buy every stock out there, but it is worth it to watch a lot of stocks, and then when the opportunities arise, try to buy those deep discounts. So anyways, that's my stock analysis on Trane Technologies. I basically hopefully that gave you a few insights. Make sure to like the video, subscribe to the channel, and I'll see you in the next stock analysis.